50 years of Federal Reserve policy mistakes explained in 1 minute. First, 1970s, the Fed kept interest rates too low for too long, completely underestimating inflation, thought that they could trade a little inflation for less unemployment. They were wrong. This led to the great inflation with prices spiraling out of control. Next, the early 2000s, after the dot-com bust, the Fed slashed rates to near zero and left them there. Flood of cheap money comes into the economy, pours into the housing market, creating one of the biggest asset bubbles in history. And we all know what happened in 2008. Then came the response to 2008, quantitative easing. The Fed starts printing trillions of dollars to buy bonds, artificially suppressing interest rates, distorting financial markets, which created massive wealth inequality and pumping up asset prices. And most recently, 2021, the Fed saw prices rising, called the inflation transitory. They kept printing money, held rates at zero for far too long, leading to the highest inflation in 40 years, forcing them to hike rates at the fastest pace in history, which leads us to today. We have an economy with inflation running hot and a Fed that is trapped because of government that is fiscally irresponsible, $39 trillion in debt, $1 trillion in interest on that debt, and then the Fed can't raise rates, so essentially they're trapped. 50 years, central planning of money consistently leads to booms, busts, and the erosion of purchasing power for the average everyday person.